Let me paint you a picture. I have $5,000 in my bank account, and I was told that the right way of living by my parents and friends is to always save some in the side. I make $2,000 a month, and I'm able to save up $200 each month, hoping one day I will be able to reach a huge sum and do whatever my mind wishes to. That's the only way I have been exposed to and even taught to increase my cash. So why don't banks do the same? Did you know that it would be practically impossible for every individual, along with their friends, family, and all other customers associated with the same bank, including you and your hard-earned cash, to collectively withdraw all funds from their respective personal bank accounts simultaneously? Where is my money? Don't worry, don't panic. It's all right. Your money hasn't vanished. Without beating around the bush too much, your money is probably invested in something or lent to someone else. The percentage of money in the reserves, aka the actual amount of money in their vaults, isn't the same for every country. To dumb down for 1 second, what is interest rate? An interest rate is the amount charged by a lender to a borrower for the use of money, typically expressed as a percentage of the principal amount borrowed. Suppose you borrow $1,000 from a bank at an annual interest rate of 5%. Here's how the calculation would work. Amount borrowed, $1,000. Rate 5%. Calculation 1,000 into 0.05 plus 1,000, which equals to $1050 to be returned after a year. Back to where we were. When the central bank wants to help the economy grow, it lowers interest rates to make borrowing cheaper. This encourages people and businesses to spend and invest more, which can boost economic growth. Conversely, when the central bank wants to control inflation, it raises interest rates to make borrowing more expensive. This reduces spending and investment, helping to slow down inflationary pressures. Now, to the banks we are directly under. Banks often make money from the spread between the interest rates they offer to depositors and the interest rates they charge on loans. This difference, known as the interest rate spread, they will make money by paying less interest to people who save money with them and charging more interest to people who borrow money from them. They keep the difference as profit. Why do multiple banks exist? And why not just have one central bank, as each country already has one? Researching the whole topic and reading about the central bank got me thinking about the need for any other bank. But after a thorough study, I figured out that it benefits the economy in various ways, such as competition, which leads to banks to offer better services, lower fees, and higher interest rates to attract customers. Having multiple banks reduces systemic risk in the financial system. If one bank faces financial difficulties or fails, it is less likely to have a catastrophic impact on the entire economy. Different banks may specialize in different areas of banking, such as retail banking, commercial banking, investment banking, or wealth management, and so on. A bank does what I think everyone should do. At first, save up some greens. Then you divide your saved up money to bonds or bank deposits that offer a fixed interest rate for your money. Invest some in stocks or indexes, and hold US dollars as a strong currency in case the value of your currency drops. You put your money to work. I should point out that everything comes with the risk. Like smoking, you enjoy the short-term gratifications of the nicotine, but you risk some health problems. I'm kidding, each one to his own. It's not like they write this on top of each cigarette box. Anyway, everything comes with a risk. Some bonds won't pay you back, and some stocks may drop in value. And then you might have wished that you have just kept your money locked up in your bedroom under the mattress and not lost anything. I thought do encourage taking risks, because once Master Uguay said, "If you don't take risks, how will you enjoy the better things in life?"